Let's bring in, on that note, Charles Schwab, Chief Investment Strategist Ann Sonders. I'm sure she has a thing or two to say about that. Good to see you, Ann. Thanks so much for joining the conversation.
Thank you.
So what do you think in terms of rates and the dollar? Robert is bringing up the strong dollar here. We have oil prices below $50 a barrel this morning. We've got a Federal Reserve possibly on hold if they do, in fact, do the rate hike tomorrow, but after that on hold. Your thoughts on where we are in terms of investing in markets today in the face of all of these outside forces?
Well, we do think the Fed raises rates tomorrow, and it's not just to make a political statement, but in line with their mandate. Maria, you were sitting on the dais at the Powell luncheon at the Economics Club of New York, and I think one of the more important things that he said was not that Fed funds rate was just below the neutral rate, but reinforcing the idea that financial market volatility alone is not going to be a trigger for the Fed, that it has to morph into financial system stability. And I think he made a very important distinction between those. In essence, sending a message, we are not going to make monetary policy changes simply because of market action. And given the fact that real rates are still only zero and the fact that the market expects a hike, I think if the Fed were to pause tomorrow and not do something, I'm not so sure that would be a positive message from a market perspective. Now, whether they pause heading into next year, data dependency is legitimate.
Right, because the president keeps talking about it. In fact, he tweeted earlier this morning on the Fed, and he said this: I hope the people over at the Fed will read today's Wall Street Journal editorial before they make yet another mistake. Also, don't let the market become any more illiquid than it already is. Stop with the $50 billion in the wind down. Feel the market. Don't just go by meaningless numbers. Good luck, writes the president. Do you think the Fed gets political and listens to the Fed, or is really what driving the Fed the actual reality of the slowdown that we're seeing, which is what I mentioned a moment ago?
I don't think the Fed gets political, and I think the market doesn't want the Fed to get political. Right. I hope the Fed does not get political. I think they should continue to operate monetary policy by looking at their dual mandate. And we have to understand that as you know, a lot of comments about don't say it's different this time, the laughter that tends to come about when you say that. But it is certainly different in this environment with rates having gone to zero, into negative territory outside the United States, $25 trillion added to global central bank balance sheets. And we're now seeing that liquidity tide come out. There are no free lunches. In even a normal environment, when you start to see tighter monetary policy, tighter financial conditions, you tend to see higher volatility in the equity market. You shorten the duration between then and a recession. You typically get a bear market. That's normal in a cycle, and I don't think we should attempt to change the cycle this time. We are going to have the end of this cycle at some point. We will get another recession. We will have a bear market. In many ways, we're already in a bear market. We've been in this stealth rolling bear market, which is a necessary repricing of many higher risk asset classes due to this very different liquidity environment. This is not a unique and abnormal situation other than the extent of this unprecedented monetary policy this time.
Well, you have, Ann, Steve Forbes here. You have earnings going up next year, not as robustly as they did after that tax cut, and the economy is still growing. Isn't it really the trade uncertainty that is hurting now capital expenditures by businesses and the global economy, that if we got that out of the way, then we'd be roaring ahead again?
I don't know about roaring ahead. I think trade is certainly one of the near-term uncertainties, but tighter financial conditions has always put downward pressure on multiples. And multiples, I think, are also under pressure because looking ahead to 2019, going from above 20% earnings growth courtesy of tax cuts to now mid-single digits. Keep in mind, too, that the #1 sector in terms of year-over-year earnings growth expectations for next year is energy. There's been almost no haircutting to earnings yet on the energy sector for the collapse we've seen in oil prices. There also hasn't been much haircutting for the strength of the dollar and the impact on exporters. So I think the path of least resistance for 2019 earnings is actually down, and we're not far from where we are toward potentially an earnings recession like we got in late 2015 and 2016. So I don't think even if some of the trade concerns are alleviated, that is all systems go for next year. Also, we've seen rate of change in the economy. Better or worse matters more than good or bad when it comes to the relationship between economic data and the stock market. Investors often forget that. It's not just is it good or is it bad, is it strong or is it weak, but what's the direction of change? And there's enough underlying weakness happening in some of the leading indicators. The average work week, notwithstanding the recent move back down, a 3-month uptrend in unemployment claims. We'll see what ISM new orders look like in the next release. So those are some chinks kind of in the armor that I think the market is keying off of.
Lizanne, first of all, I thought your 2019 market outlook piece was great, a really great read. And I agree with you that the strong dollar is something people aren't focused on going into 19, especially with exports and manufacturing. But my question to you is, can you talk a little about the lack of inflation we're seeing, and where do you see that impacting maybe a slowly raising rate environment and maybe a slowdown? It feels a little like, you know, you feel like there could be a stagnation coming the way you kind of talk about it.
Right. So there are long-term global secular pressures down on inflation, which I think will persist as, you know, in the near to medium term. What we don't know is whether we're going to start to see some cyclical pressures on the upside, courtesy of the tight labor market. And that's what makes it difficult sometimes for the Fed. It puts them in a little bit of a pickle because unlike other central banks that only have a single mandate in inflation, the Fed has the dual mandate of full employment and price stability. And although we've got price stability, we've got the tightness in the labor market and the increase in wages, which is great for workers, but could start to filter into rising core measures of inflation. And given that core CPI is running above the Fed's target, they have to operate right now with their mandates maybe sending slightly different messages right now. And it is a difficult environment for them. But given that real rates are at 0 right now, I don't think a hike this week suggests that it's a major mistake and they've gone way too far on the tightening side.
Any thoughts on oil where it is? Is that indicating that we're seeing a sharp slowdown across the world? I mean, oil below 50, it's either an indicator or it's going to be a positive for the economy, right?
I think there's a component of it reflecting global demand, but there's also obviously the supply side of the story as well. You know, we're at a level now, 48. You know, I'm not an expert on oil, but there is sort of a sweet spot where it's high enough to be above break-evens for the shale and fracking companies, but low enough that it's still a boost to the consumer part of the sector. But remember, when we saw the collapse back in 2014 into 2015, it did lead to a 4 consecutive quarter earnings recession and did cause hits to the capital spending side, energy related. So we do have to be mindful that this is not a purely positive story anymore as it relates to lower oil prices simply being a benefit to the consumer.
I totally agree. Liz Ann, it's good to see you this morning. Thanks so much.
Thanks.
Liz Ann Sonders joining us.